picture the scenario for exam day. You are staring at this massive, just really complex computation problem.
Oh, the kind that spans half a page.
Exactly. And you've successfully navigated the gross income, you've perfectly calculated the deductible expenses, and you've even nailed the value-added tax output and input down to the last centavo.
A great feeling.
Right. So you select option B, feeling like a total genius, but you still lose the points.
Yep.
Why? Because buried in those facts was a single tiny detail about manufacturing a specific good, and you completely forgot the hidden toll booth, the excise tax.
It is honestly one of the most painful ways to drop points on the taxation portion of the Philippine CPA board exam.
It really is.
Examiners construct these elaborate scenarios specifically to see if you remember that certain goods carry an entirely separate additional layer of tax liability. If you don't factor it in, your entire final computation just collapses.
And collapsing on exam day is definitely not on the agenda for you, our listener. Welcome to the special review session on ICPA Review Radio.
Glad to be here for this one.
If you are currently staring at a mountain of tax reviewers trying to decode the National Internal Revenue Code, just take a breath. We've got you covered. Today, we are going to do a deep dive into excise taxes.
Specifically, the rules governing production, removal, and importation under sections 129 to 132.
Right. And to build our foundation, we need to establish exactly what triggers this tax, right?
Yeah, so excise tax applies to three distinct categories. You have goods manufactured or produced in the Philippines for domestic sale or consumption, then goods imported into the Philippines, and finally, certain specific services performed locally.
Let me stop you right there, though, to clear up a major misconception that traps a lot of first-time reviewees.
Oh, I know which one you're talking about.
Right. I hear candidates argue that if a product is hit with an excise tax, like a luxury car or, a bottle of whiskey, it must be exempt from VAT, because taxing it twice would be, double taxation.
That is a highly testable and completely false assumption.
Completely false.
The tax code explicitly states that the excise tax is imposed in addition to the value-added tax. They are completely separate levers.
Wait, so you absolutely pay both?
You absolutely pay both. VAT is a broad-based tax on the value added at each stage of a transaction, right? But excise tax is a targeted regulatory tool.
Ah, got it.
Yeah, it's designed to curb the consumption of sin products, or to tax luxury wealth, or even compensate the state for resource depletion. Because the government has totally different policy goals for each, you get hit with both.
So the government is basically double dipping, but doing it legally?
Exactly.
I'll make sure to keep that in mind. So now that we know we have to compute it, let's talk about the mechanics. The code divides excise taxes into two main categories, right? Specific and ad valorem.
Correct. As amended by RA 1963.
So a specific tax is purely quantitative. It's based on physical units like weight or volume capacity, things you can actually measure with a scale or a measuring cup.
Yeah, and then the second category, the ad valorem tax, is qualitative. It is based on the selling price or another specified value of the good or service. And this is where examiners love to hide their computational traps.
Because physical volume is hard to fake, but value is, well, highly subjective.
Exactly.
Let's use an analogy to really lock this in for you guys listening. Think of a specific tax, like the cover charge at a nightclub.
I like that.
The bouncer charges you 500 pesos to walk through the door, right? And he doesn't care whether you plan to drink tap water all night or, buy out the entire bar. The tax only cares about the physical unit, one person, one entry.
Right.
But an ad valorem tax, that is the VIP section charging you a mandatory 20% service fee on your total bar tab. The more expensive the items you consume, the exponentially higher the fee.
That perfectly illustrates the difference. A cover charge is fixed and predictable. The VIP percentage fee is variable.
Which means the person paying it has a strong incentive to artificially lower the tab on paper to save money.
Oh, absolutely. And the Bureau of Internal Revenue knows this.
Which brings us to the whole strategy of tax evasion, or rather how the law prevents it. Like, if I'm a manufacturer producing high-end luxury goods subject to an ad valorem tax, I don't want to pay a percentage on my massive retail price.
Obviously not.
So I set up a dummy sister company. I manufacture the good, sell it to my sister company for absolute pennies, and pay a tiny ad valorem tax. Then my sister company sells it to the public at the normal, exorbitant markup.
Yeah, the BIR's transfer pricing regulations will shut that down immediately on the exam.
Boom! Denied.
The statutory safeguard under Section 130B explicitly states that the tax base is the wholesale price at the place of production, excluding VAT.
Okay, excluding VAT.
Right. But if a manufacturer sells to their own establishment or an entity where they hold a profit interest, the BIR ignores that first dummy transaction entirely.
Oh, wow.
Yeah, the wholesale price of that second establishment becomes the new baseline.
Okay, I'll pivot my strategy then. What if my sister company also declares a suspiciously low wholesale price and we just make our real profit through, I don't know, under-the-table consulting fees? We just suppress the declared price across the entire supply chain.
Then you slam right into the mandatory floor calculation.
Ah.
This is commonly known as the 10% rule, and it's prime real estate for a computational multiple choice question.
Okay, I'm listening.
If the declared wholesale price is less than the cost of manufacture plus expenses, the law steps in and mandates a minimum rational economic baseline for a for-profit business.
Okay, walk me through the exact math I need to perform on my exam scratchpad if I spot this. Let's do a scenario.
Let's say the problem states a manufacturer's direct cost to produce a batch of goods is 100,000 pesos.
Got it. 100,000.
The expenses incurred to bring those goods to the point of sale are another 20,000 pesos. But the manufacturer claims their gross selling price is only 115,000 pesos.
Wait, 100,000 in costs plus 20,000 in expenses is 120,000 pesos. They are claiming they sold it for 115,000. They're literally selling at a loss just to lower their tax base.
Exactly. So on exam day, you discard their 115,000 declared price entirely.
Just throw it out.
Throw it out. You take the 100,000 cost, add the 20,000 expenses, giving you 120,000.
Okay.
Then the law requires you to add a proportionate margin of profit, which cannot be less than 10% of that combined cost and expense figure.
All right, so 10% of the 120,000 total is 12,000 pesos.
Yep.
I add that 12,000 profit margin back to the 120,000 base.
Yeah.
So my legally mandated gross selling price for the ad valorem tax computation is 132,000 pesos.
That is the precise sequence.
Nice.
The trap candidates fall into is calculating the 10% profit margin based only on the manufacturing cost, forgetting to include the expenses before applying the percentage.
Oh, that's sneaky.
Always group costs and expenses first.
That is a lifesaver. Okay, so we've manufactured the good, we defeated the transfer pricing traps, and we have our ironclad tax base.
Yeah.
The next logical step in the product life cycle is moving it out of the warehouse. And this is where examiners shift from computational questions to conceptual timing questions, like when is this tax actually due?
The golden rule for domestic products is strict and unforgiving. The return must be filed and the excise tax paid before the removal of the domestic products from the place of production.
Okay, I tell my reviewees to memorize the phrase, pay before you play.
That's a good one.
Or in this context, pay before it leaves the bay. If a pallet of excisable goods crosses the threshold of the factory door, the BIR expects that tax to already be in their accounts.
Yes, they do.
If it isn't, whoever is caught holding the bag is suddenly in a lot of trouble.
It's a brilliant enforcement mechanism, honestly. If customs or revenue officers find a truck full of untaxed liquor on the highway, they don't have to launch a 6-month investigation to find the original distillery.
That makes sense.
The law allows them to hold the person in possession liable. It forces the entire supply chain to police itself.
I see. That makes total sense for a discrete product like a bottle of liquor or a luxury car. But what about continuous extraction? Like, if I'm operating a natural gas pipeline or an offshore oil rig, the product is constantly being removed from the earth. I can't have my accounting department filing a new tax return every 30 seconds as the gas flows.
You've identified the exact administrative nightmare that necessitates statutory exceptions. And examiners test these exceptions relentlessly because they shift either the timing of the payment or the person liable.
Okay, let's look at indigenous petroleum and natural gas. Let me guess. Instead of paying before removal, they just pay a massive lump sum at the end of the year based on the meter readings.
Actually, no. The law completely shifts the burden away from the extractor.
Wait, really?
Yeah. For indigenous petroleum, the excise tax is paid by the first buyer, purchaser, or transferee for local sale.
Oh, wow. That is a vicious multiple choice trap.
It really is.
If the question asks who is primarily liable for the excise tax on indigenous petroleum, and option A is the oil drilling consortium, candidates are totally going to jump on it.
They will.
But the correct answer is the refinery, or the corporation that buys it from them.
Precisely. It is significantly easier for the BIR to track and tax a massive commercial transaction between two corporate entities than it is to continuously monitor a wellhead in the middle of the ocean.
Fair enough. What about mining, then? Does the person buying the gold pay the tax?
No, mining has its own distinct set of rules.
Of course it does.
Right. For exported mining products, the tax is paid by the owner, lessee, or operator of the mining claim.
Okay.
But for locally extracted metallic minerals, the exception is all about timing. You don't pay before removal. The person liable must file a return and pay the tax within 15 days after the end of the calendar quarter when the products were removed.
Wait, 15 days after the quarter ends? That could be months of untaxed gold leaving the mine. Why is the government suddenly being so generous with credit?
It's not generosity, actually. It's scientific necessity.
How so?
Metallic ores have to be assayed. They have to be tested and chemically refined to determine their actual mineral content and value. A ton of rock dug out of the ground isn't a ton of gold. You literally don't know the value of what you've removed until it's processed. So the law gives you the quarter plus 15 days to complete the assaying, determine the true value, and pay the tax.
I see the logic, but the BIR doesn't strike me as an agency that operates on the honor system.
Definitely not.
How do they know the mining company won't just liquidate the refined gold and disappear before day 15 of the new quarter?
They secure their position up front. The taxpayer is required to file a bond in an amount that approximates the expected excise tax due on the removals for that quarter.
Oh, a bond.
Yeah, basically a massive security deposit. If you default, the government seizes the bond.
Makes sense. We should also quickly mention imported minerals, just to close the loop on resource extraction. If I import metallic or non-metallic minerals, what's the timing?
For imported minerals, we revert to a variation of the general rule. The tax is due before their removal from customs custody. You pay before they enter the domestic market.
Okay, let's follow the physical movement of these goods. We've covered manufacturing, and we've covered moving them out of the factory into the local market.
Right.
What if that truck drives straight to the port, bypassing the local market entirely, and ships the goods overseas? Let's talk about exports under Section 130D.
Well, the government generally wants to encourage international trade because it brings foreign currency into the economy.
Naturally.
So the baseline rule is that when locally produced goods are actually exported without returning to the Philippines, and the corresponding foreign exchange payment is received and accounted for, any excise tax paid on those goods can be credited or refunded.
Okay, so if I manufacture 1,000 bottles of premium local rum, pay the excise tax to get them out of the distillery, and then ship them to a distributor in Tokyo, I can apply for a tax credit once the Japanese yen hits my corporate bank account.
That is a perfect application of the general export rule.
Excellent. I'm going to expand my business then. I buy a mining claim, extract tons of high-grade copper, pay my excise tax via bond, and export the entire shipment to an electronics manufacturer in South Korea.
Okay.
The foreign exchange clears. I file for my massive excise tax refund to maximize my profit margin.
And your claim will be immediately denied by the BIR.
Ouch!
Yeah. This is one of the most critical red flags in this entire topic. The tax code contains a massive exception regarding natural resources. It explicitly states that the excise tax on mineral products is not creditable or refundable, even if they are genuinely exported.
Well, wait, the double standard. Rum gets a refund, but copper doesn't. They both bring in foreign currency.
It comes down to the Philippine Constitution and the concept of national patrimony.
Oh, the patrimony angle.
Exactly. Rum is agricultural. You can grow more sugarcane next year. But mineral ores are finite, non-renewable physical assets. When you dig up copper and ship it to Korea, the Philippines permanently loses a piece of its physical wealth.
That makes a lot of sense.
The government insists on retaining the excise tax to compensate the state for that permanent depletion of the national domain, regardless of where the minerals ultimately end up.
When you explain the policy behind it, the rule makes perfect logical sense. But for our candidates memorizing lists at 2 a.m., is there any exception to this non-refund rule for minerals?
There is always a carve-out in taxation.
Always.
The non-refund rule applies to mineral products, except for coal and coke.
I have a quick recall aid for this exact exam scenario for our listeners. Just repeat this in your head. Miners dig deep, but no refunds to keep, except for coal and coke.
That's brilliant.
If the exam question involves gold, silver, copper, or nickel being exported, you select no refund. If the question specifically mentions coal being exported, the refund is back on the table.
Mnemonics like that are exactly what save you under time pressure.
Absolutely.
Now, we've tracked goods going out of the country. Let's reverse the flow and look at the exam traps for goods coming in, importing excisable goods under Section 131.
This is where things get messy, especially regarding tax-exempt entities. Let's establish the baseline. You pay customs before the release of the articles.
Right.
But what if I try another evasion tactic? I set up a registered charitable foundation which has tax-exempt status. I use the charity to import a fleet of luxury SUVs tax-free. Then, the charity quietly sells those SUVs to my wealthy friends at a massive discount.
The law anticipates this exact scheme.
Of course it does.
If a tax-exempt entity imports excisable goods tax-free and then subsequently sells, transfers, or even just gives them to a non-exempt person, the purchaser or transferee immediately becomes liable for the excise tax.
So the tax debt basically follows the asset.
In the eyes of the law, that final purchaser is treated as the original importer.
Well, that ruins my charity scheme. But I have another real-world scenario that candidates will definitely relate to.
Let's hear it.
Let's say after the board exams, I take a celebratory weekend trip to a chartered free port, like the Southwick Special Economic and Freeport Zone. I walk into a store with a giant neon sign that says duty-free. I buy a box of imported cigars and 3 bottles of imported wine to take back to Manila. I am completely safe from excise tax because I bought it in a designated economic zone, right?
That neon sign is legally accurate regarding customs, but entirely misleading regarding internal revenue.
Oh, no.
The law specifically targets what we categorize as sin products, so cigars, cigarettes, distilled spirits, fermented liquors, and wines. The tax code explicitly states that the importation of these specific goods, even if destined for tax and duty-free shops and free ports, shall be subject to all applicable internal revenue taxes, including excise taxes.
Wait, really? So what does the duty-free part actually mean for alcohol and tobacco?
It means they are exempt from customs duties only.
Just duties.
Just duties. The government is fiercely protective of its health-related tax policies. You cannot bypass public health sin taxes just by doing your shopping inside a special economic zone.
So the stores in Subic have to pay the excise tax on those bottles. How does the BIR actually police that on the ground? Do they inspect every bottle?
They have strict compliance labels. Articles imported by duty-free shops must be clearly labeled duty-free and not for resale.
Okay.
If revenue officers find imported spirits or cigars in a duty-free shop without those specific markings, or worse, if they find those marked items being resold in a regular store outside the zone, the penalties are severe.
I assume massive fines and closure of the business.
Fines, yes, but the immediate action is confiscation of the goods. And the law includes a very specific mandate. Confiscated, untaxed articles must be destroyed using the most environmentally friendly method available.
Environmentally friendly. That's an interesting detail.
It is. More importantly for the exam, the unpaid tax on those goods constitutes a superior lien on the article itself.
Let's define superior lien for the reviewees, because that's a heavily tested concept in both taxation and business law.
Yep.
It means the government's claim for the unpaid tax attaches directly to the physical item, and the government gets absolute first priority over any other creditor. You cannot escape the tax debt by transferring possession to an innocent third party. The BIR will seize the asset to satisfy the debt, regardless of who is holding it.
Exactly. The government's claim supersedes all private contracts.
Before we wrap up, I want to dive into one highly specific computational trap regarding imported spirits under Section 132.
Okay, let's do it.
It's about how to calculate the taxable volume of a cask or package. I can easily see an examiner bearing this in a massive word problem. Can you walk us through the fractional rounding rules?
Gladly. When dealing with imported spirits in a cask or package that contains more than 1 liter, the computation focuses on the fractional part of the volume.
Right.
The rule is simple. Any fractional part of a proof liter that is equal to or greater than a half liter, meaning 0.5 or above, is rounded up and taxed as 1 whole liter.
Okay.
Any fractional part smaller than 0.5 is ignored. It is totally exempt.
Let's test this on the scratch pad. I import a cask that contains exactly 5.6 proof liters. The 0.6 fraction is greater than 0.5, so I round up the fraction to a whole 1. I am taxed for 6 full liters.
All right.
Scenario 2, the cask is 5.4 liters. The 0.4 fraction is less than 0.5, so the fraction is exempt. I am taxed on exactly 5 liters.
Spot on. But here's the loophole the examiners will tempt you with.
Uh-oh.
What if you import a single fancy bottle of imported spirit, and the total volume of that bottle is only 0.3 liters?
Well, applying the rule, 0.3 is less than 0.5. Therefore, the fraction is exempt, which brings my taxable volume down to 0, free tax-exempt whiskey. I'll just import 10,000.3-liter bottles.
And that is exactly why the law has an absolute floor.
Ah, they thought of that.
They did. The fractional rounding rule only applies to a package containing more than 1 liter. The statute clearly dictates that any package of spirits where the total content is less than a proof liter shall be automatically taxed as 1 whole liter.
Oh, that is brutal. So the government sees the loophole manipulating package sizes to evade taxes and slams it shut. Every single one of those tiny 0.3-liter bottles would be individually taxed as if they were a full 1-liter bottle.
Yep.
That is an incredible trap for a multiple-choice question.
It forces businesses to act efficiently rather than just playing games with packaging dimensions.
We have covered a tremendous amount of ground today, from manufacturing floors to export ships and duty-free zones. For everyone listening, congratulations on surviving one of the denser topics in the tax code.
It's a lot to take in.
It really is. You are significantly more prepared for exam day than you were 15 minutes ago. Let's hand it back to our expert to consolidate this into a rapid-fire 3-point exam day checklist.
Here are your 3 must-remember takeaways for excise taxes. Number 1, excise tax is always in addition to VAT. And when calculating ad valorem taxes, watch out for the 10% minimum profit margin rule. If a manufacturer's wholesale price to a related party is suspiciously low, you must establish the tax base by adding cost plus expenses and then adding at least a 10% profit margin on top of that combined total.
Number 2.
Timing and exceptions. The general rule is pay before you pay before removal from the production site. But remember the key exceptions. Metallic minerals get 15 days post-quarter to pay with a secured bond. And for indigenous petroleum, the tax burden completely shifts to the first buyer for local sale.
And number 3?
The sin tax duty-free illusion. Alcohol and tobacco imported into free ports are exempt from customs duties, but they are never exempt from internal revenue excise taxes.
Right.
Furthermore, exported minerals do not qualify for tax refunds due to national patrimony, unless the mineral is coal or coke.
An incredibly precise checklist. As you head back to your highlighters and review notes, I want to leave you with one final provocative thought to ponder during your study breaks.
Well, let's hear it.
We mentioned earlier that the law requires confiscated, untaxed goods to be destroyed using environmentally friendly methods. Think about the significance of that phrasing in a tax code. Why is the Bureau of Internal Revenue suddenly mandating ecological standards for the disposal of illicit cigarettes?
It's a huge shift.
It really is. Consider how the intersection of taxation and environmental policy is slowly but surely creeping into our legal frameworks. As the global economy pivots toward climate consciousness, what other industries might soon find eco-friendly compliance strings attached directly to their tax liabilities?
That's a great point.
Will we soon see carbon footprint metrics woven directly into ad valorem computations? It's a fascinating evolution of the law to watch as you prepare to enter the profession.
It raises a vital question about the future of the CPA profession, honestly. You won't just be calculating revenue. You may soon be auditing environmental compliance as a core component of tax liability.
Absolutely. So keep pushing forward, trust the hours you're putting into your review, and always keep an eye out for those hidden toll booths in the computation problems.
You've got this.
You have the knowledge you need to crush the CPA board exam. Until next time, this has been your deep dive.